This is how the stock market works for beginners. Back in the 1600s, a company called the Dutch East Indian Company set out to sell goods like gold and spices. However, the East Indian Company was faced with a huge problem. They didn't have the finances to actually fund the voyage and pay for the employers and even the ships themselves. So they reached out to civilians to ask if they could fund the voyage. In exchange, they'd be given a share of the profits. By doing this, it gave the East Indian Company even more ships, employees, and even goods than they even expected, which resulted in the voyage being extremely successful and out-earning well beyond what they even imagined, which made the East Indian Company happy and the investors themselves. With this wild success, the Dutch East Indian Company began to continue to sell shares of their profits all around the world, and before you knew it, they invented the first stock market. Today, the stock market has grown immensely, making it far more complicated than what it was back then. I mean, today we have careers based strictly on understanding the market because it's grown so much.
Okay, so then how does it work today?
Let's say there's a new water company who wants to launch on the market. First, the water company would advertise to private investors. If the private investors think that the water company is a good idea, then they have the ability to invest first by sponsoring the company's initial public offering, or what we call in the investing world, an IPO. The IPO then launches the water company onto the market, where corporations and individuals who believe in the water company now have the ability to buy stock. When a corporation or individual buys stock, it makes them partial owners of the company. In exchange, the company then uses the money that the investor paid to promote the company and to try to continue to grow in revenue. In short, become more profitable. As the water company becomes more successful, people begin to buy more and more shares. As the demand for the shares increases, so does their price, which also increases the prices of shares already owned. But before you go ahead and click the buy button, shares don't just go up, they can also go down. If the water company starts to seem less profitable, then investors will then sell their shares in hopes to maximize their profits before the cost of the shares goes down. The reason this is done is because the more shares that are sold of the company, the less the demand for the company there is, making the shares less valuable. I mean, people do sometimes sell shares for personal interest, which also does make the demand go down as well, which can leave investors with big losses. That is, unless the company can start to look profitable again, which does happen sometimes. In other words, the stock market is just one giant game of supply and demand. When people invest, they take into consideration things like production technologies, the ever-shifting cost of labor, changes in leadership positions, bad publicity, or larger factors like new laws.